Okay, great. It's 4, so why don't we get started? So first of all, guys, I just wanted to hope that all you guys are staying safe. At least in my personal circle here in Mumbai, COVID was always a theoretical threat because no one had fallen ill with the disease that I knew of in India. And that's changed recently, and two people I know have, one indirectly and one directly have fallen ill. So I think it's important for all of us to continue to stay really vigilant. Um, and I hope all of you are staying safe. So that's on the first introductory note. And the second introductory note I wanted to make is that I've seen a lot of you joining, some of you joining our beginner sessions, and I'd really encourage advanced listeners to also join for those, because these beginner sessions are really proving to be quite enjoyable one to conduct, and also the questions we're getting, etc., are remarkably deep and subtle, and we're covering some very counterintuitive facts that I think a lot of listeners could benefit from. So look out for those beginner sessions too. And the best way to do that is go to our YouTube channel. You can see all our videos there. Anita will send a link to that in the chat. Now, thirdly, this is going to be our penultimate session for this series that we're doing on stocks, zero to hero. So we're almost at the end, one more session in another 2 weeks, and then we'll be done. So as Anita briefly mentioned, to those of you that joined early, we'd love to get your thoughts on where you want us to go from here. You know, this is a member-driven club, and we want to produce content that's helpful for you guys. So if you really want a session on real estate, we can cover real estate. If you really want a session on, passive investing, we can do one on passive investing. So please keep suggestions coming in through advisory@barosaclub.com, and we look at the various suggestions and then make a determination on what we're going to cover next. And then the last thing I wanted to cover for our advanced listeners and members, we released a research paper on UPL. So United Phosphates. It's a stock that we recently added into our small case, and it represents a very good example of how you put all these tools together that we learned about in stocks zero to hero into making an investment decision. And it's a company that has a less than pristine balance sheet. So unlike Britannia, there's actually some balance sheet work that we did on assessing the stock before we made the decision to invest in it. So I think it would be a very good thing to do, to read that paper after going through this course. So keep an eye out for that also. Okay, great. So why don't we get started on today's class? Okay, so a brief recap of last time. So we learned how to look at quarterly numbers, and we learned how to construct last 12-month financials. So if you remember, last 12-month financials basically give us a picture of how the company's done over the most recent 12-month period. So it gives us the most recent set of annual numbers that we have. So that's why they're valuable. It gives us the latest picture of how the company is doing. And we use the earnings per share from that last 12 months financials to calculate the PE ratio, the current PE ratio of Britannia. And we also began tackling our question list and try to chip away at all those questions we had been keeping track of. So in this class, what we're going to do is we're going to quickly update our Britannia analysis for the latest quarter that actually got released this last week. So we're going to very quickly just update the numbers again for the latest quarter and see what that implies about how the company is doing. And we're going to plow through all those questions that we've had on our lists and try to answer as many of these as possible. And then we're going to prepare for our final class, which is where we'll discuss how you make a decision on whether Britannia is a good investment or not. And the important thing is, as we prepare for the last session,
Anita,
in that last session, I'm not going to, Anita, can you mute the lines? In that last session, we're not going to necessarily pound the table and say invest or don't invest. That's really not the goal of the class that we're doing here. Those are what our research papers are for, giving you a sense of what stocks we like and how we got to those decisions and all. What we'd love to do in that last session is basically lay out the key things you should think about in making all those decisions. And really the decision is with you. Now we've all looked at Britannia together, and everyone can come up with their own unique views on whether the stock is good or bad. You know, great investors always disagree on investment decisions, right? And you know, that's the beauty of investing. It's an art, not a science. So I'd love at the end of that session to hear what you guys think. So write into us at advisory and let us know your thoughts on whether Britannia is a good investment or not. Okay, so let's start with the Q4 results. So Britannia released Q4 results and full year 2020 results this past week. And the results were fairly interesting. So I've highlighted in yellow some of the key takeaways. But first, let me just explain what I've done to the chart. So you'll notice this P&L is the exact same format that we've always been using, right? But I've made a few additions. So one is I added the full year 2020 numbers here. So before we only had 2019 and LTM. Now I've added 2020 because we now have those numbers. And then I've also added just Q4 to know how they did in the latest quarter versus a year ago. So this is how they did this year in that quarter, and this is how they did last year. So we can see how the company is trending in the latest quarter. So let's start with the 2020 numbers. What can we tell here? So I've highlighted in yellow the key points. So let's start with the first thing being revenue growth. How did Britannia do in terms of growing that top line? So if we see here, there's definitely been a deceleration in 2020, and we had noticed that even through the Q3 numbers that we had seen earlier in last class. So we're really going to want to understand this deceleration and figure out what's going on there. The next thing we noticed, and this is again consistent to our Q3 analysis, the company posted a very strong earnings per share growth number despite lower sales growth, revenue growth. So despite selling less products, or not selling less products, but growing their sales of products less quickly than they had in the past, they were still able to grow their earnings at a very fast rate. So why is that? So in the last class, we had discussed that tax expense was one of the key reasons. And one of our listeners had actually pointed out that that's because the tax rate came down. That very much can be seen also in the Q4 numbers. So you can see that that same theme obviously carried out for the full year, and their earnings per share grew 31%. But now the key question we should be asking as investors when we look at that 31% earnings per share growth number, do we expect the tax rate to get further cut next year, right? And the answer is no, barring some kind of change that we expect. So another point that we looked at that I calculated was what would the earnings per share growth rate have been if the tax rate had stayed the same? Because I want to know how fast are future earnings going to grow. And if I don't expect any tax rate cuts in the future, I want to know how quickly that earnings per share number will grow at a sales growth level. So I got a number of 10%. So that means 20% of that earnings growth was due to the tax rate change. So as we think about looking forward, we can expect on 6% revenue growth and earnings per share growth of around 10% for the company, right? So that's a more realistic number to look at. Now, the next couple of things that were interesting that I highlighted in yellow was one, our new earnings per share number, right? 61 rupees. So when we calculate our new PE ratios, we're going to be using that 61 rupees as a denominator, because that's our latest earnings number for them. And then the other thing that's unusual is, remember we had talked about how Britannia had very little in finance costs and the balance sheet was very clean. Well, this year their finance costs have grown from 2 crores to 65 crores. So clearly they've added some debt to the balance sheet. It's not a lot of debt, not a lot of borrowings, but this is something that's interesting for a company that has been running at basically zero borrowings in the past. So that's an interesting thing that we're also going to want to dig into. Now, if we look at the Q4 comparison, revenue growth was around 2%. And we look at the gross margins, right? So the gross margins we had noticed in Q3 had deteriorated in last class. We see the same deterioration in Q4. The Q4 gross margins are about 200 basis points lower than they were last year. So we're going to want to understand what is driving that gross margin down, and does that imply that maybe the future is going to see more gross margin compression? So as we start thinking about future earnings, do we need to factor that into our calculation? So that's kind of my highlights from the Q4 numbers. Now let's go to the question list. So I've just reproduced our old question lists. Most of our old questions still carried forward even past the Q4 numbers. There's just one I added here, which was Britannia looks like they've added debt in the current year. We need to look at how much, right? And why. The ones in green are questions that we've already addressed in the past, and the ones in black are the ones that we're going to address in this class. So these were one set of questions. And then we had some other questions also that were related to other topics. So we're going to cover each of these here today. Okay, so if you remember, our main tools for answering these questions are the analyst call transcripts, the presentations that the company has, and then also Googling around and doing your own desktop research, or even talking to stores, etc. if you want to do some field work, right? But you can learn a surprising amount through doing that. And you'll see as we go through this question list, we will have been able to answer all of our questions that we had just through these tools. So it's pretty amazing what you can do with the information at your disposal. So let's start. So our first question, what is happening in the current year to explain the slowdown in revenue growth? So I went through the transcripts and I tried to see if the management team gave us any commentary on what was happening. And we got some of that. So here are a few quotes that I want to read out. So all of you are aware of the economic slowdown that we are facing in the country. We are not dumping at all. We have improved our distributors' health. So basically what this quote tells me, and what I can infer from this quote, the economic slowdown that most of India was facing even before COVID was being felt by Britannia. And the way it was being felt was through its distributors. So when they say we are not dumping at all, what they mean is they're not dumping their products on their distributors and forcing them to take product that they don't want to take, right? So they're allowing their distributors to lower their stock levels. So, and they're focused on improving their distributors' health. So as I think about this, the economic slowdown is kind of playing out as follows. There are Kirana stores that hold a bunch of product that they're trying to sell to customers. Maybe their sales are trending down, etc., or whatever. They want to reduce their stock levels, or maybe they've taken out too much debt and they need to lower the debt and all those things and take less inventory on. So Britannia is being able to sell less to the distributors in terms of primary sales. Okay, what else did they say? They say we have also got direct reach, which is today 21.7 lakh outlets. This year, obviously, the gains are not as much as they have been in the last 2 or 3 years. So you'll remember in our past videos, when I was looking at what was driving the sales growth Britannia had seen in the past, we had seen that they were increasing their distribution outlets by going into rural regions and going deeper into the country. So more and more stores were selling Britannia products. And one of the questions we had asked, how long can this continue, right? So what we're seeing here in this year is that perhaps there's some signs of saturation, right? Because they're slowing down. This year, obviously, the gains are not as much as they have been in the last 2 or 3 years. So that also explains why sales are coming down a little bit. They're not sales growth. They're not seeing as much growth in outlets as they were in the past. So that's also another interesting data point as we think through revenue growth in the future, right? Will they be able to get back to the 12% revenue growth that they were showing in the past? Maybe not, if they're tapping out on the distributors that are expansion that they've been seeing. Okay, so what was on other questions? So what drove the 2019 gross margin increase? So we had seen that the gross margins had increased a few hundred basis points in 2019, and we weren't sure why. So the answer is that because of a business model change, some costs are moving to other expenses. So what that tells me is that this is an accounting thing that explains the discrepancy in gross margin. Essentially, Britannia was booking some costs in cost of goods sold that got moved to other expenses. They're still paying those costs, but they're no longer falling in the cost of goods sold. So what that tells me is that that gross margin increase was not due to greater pricing power. It was just due to some change in allocation of where the costs fell through. So it's not a real reflection that the margins increased because of changes in pricing power. Okay, then the next trend that we had seen is looks like gross margins have deteriorated in back half of 2020. Why? So here are some quotes that we got from the analyst call. On a year-on-year basis, you are showing 1% of price increases and 3% of cost inflation. So what is this telling us? This is telling us that Britannia's costs of goods are increasing at 3%, but their prices are only increasing at 1%. So even adjusting for the fact that the prices are higher than the costs, they're not being able to fully pass on their cost of inflation. So if they're paying more for doodh and they're paying more for flour and wheat, they're not able to pass on all that increase in price through to the consumer. So that's why you're seeing some margin compression due to that. And in particular, they cited dairy. Dairy has been a very tough year. The milk prices, there has been a huge upsurge in milk prices. So now we're getting a better picture of why the margins are compressing. Okay, the next thing that we noticed was Britannia seems to have become more efficient in cost management. Their operating margins were expanding, and on the wake in the wake of cost efficiencies that they've implemented. So the management team also talked about this. They said, we do zero-based budgeting. We are in the process of planning for next year so that we can hit the ground running. We are looking at improving productivities, reducing waste, and reducing distance that our biscuits travel to get to the customer. So zero-based budgeting basically means they're starting from scratch when they're building that budget for every year, and they're asking themselves every year, do we need this expense or not? Right? They're not taking for granted that they need any expenses, and anything that they don't need, they're cutting. Now, zero-based budgeting tends to be very effective in the beginning when you implement it, and less effective year on year. But it sounds like they still think there's some opportunity for next year. They're saying we are in the process of planning for next year so that we can hit the ground running. So maybe we can expect a little more efficiencies to creep in the next year, but maybe not as much as we saw in the past. Okay, so what were some of the other questions that we had on Britannia? So we wanted to get a sense of market share in the core product categories. We wanted to know how powerful are Britannia's brands. So the management team addressed this also. And the good news is that their products seem to have really significant market share and very good brands also. So they say that in biscuits, we have a 35 to 40% market share. Then I did some Googling to see if I could figure out what their bread market share was. And they have a 30% share according to a research firm, Euromonitor, which is a very well-regarded research firm. So their market shares are very good in their two sort of core product areas. And they're also seeing increases in market share. So we haven't seen a larger market share increase than what we are seeing this year. So despite Britannia's sales growth slowing down, this seems to have been an industry-wide trend and not in particular to Britannia, because Britannia is claiming that they actually gained market share at a very fast rate this year. So they're actually outperforming their competitors, according to the management team. So that's always comforting to see as someone that's looking to invest in stock, that the company is doing better than the industry. So the other thing that we are very curious about is Britannia, if you remember, had a strategy of getting into new product categories. They wanted to become a food company outside of just a bakery company. And so one of the questions that we had was, well, how are Britannia's new product launches doing? Are they really going to be able to expand into salty snacks and milkshakes and croissants and all these categories, right? So we have some tidbits that will help us understand. So if you look at our growth, almost half of it is from our base business, 1% from innovation, and 1% from new categories. So a 1% boost to revenue growth is pretty small for a new product categories. So it doesn't seem like they're really exploding these new product categories in a very big way, although they are adding to the top line growth of this that we're seeing. We are not expanding salted snacks from the test markets that we have. And I would think that, challenges, there are a few challenges in every category that you get into. And that's what helps us. The test market really helps us fine tune those till we get to a national launch. So I would see no red flags at this point. Forgive the language, it's a bit clunky. This is from the analyst call, but just translating what the management team is saying here. They're saying that they've tested salty snacks. They're not ready to roll salty snacks out to a pan-India basis yet because they're seeing a few challenges that they need to figure out, but they still want to go ahead with it. There's not seeing any red flags that will be a game changer saying, no, we want to remove this salty snacks expansion. So that's also a kind of lukewarm signal that we're seeing that, hey, maybe the rollout is taking a little longer than they expected. Still seems like it's on track, but maybe a little more challenging than they thought. Between croissants and salty snacks going all out in pan-India, maybe croissants will be the next 3 to 4 months and salty snacks would probably be in the next 6 months. This was taken from the Q3 analyst call, so before COVID. I don't know if these timelines have further gotten pushed out from there. So, but it still sounds like these categories are taking some time to fructify for Britannia. But the good news is that despite that, the core business seems to be doing relatively well. So as an investor, right, one thing is you're interested in is how are your legacy bread and butter products selling? And then 2, how are your growth areas doing? So the way I read this is growth areas maybe not doing so well, core business doing pretty well. So what do we think the margin impact is going to be of their new products? So one of the areas I was very concerned about is, are they really risking a lot on these new products? Are these products going to come in at very dilutive gross margins and all these things? So it turns out that they're not, and this is a very good thing. The gross margins are accretive to the products that we sell. We have got technology which is superior. We have got a twin screw extruder. So basically what Britannia is doing is they have technology that they can apply to these new product categories. They're not going into categories that require them to build out completely new technology, right? They're actually leveraging technology that already exists, which is allowing them to sell these products at a good profit margin. And that's very good to see, because if a new product doesn't work, then you say, okay, maybe you set up a few lines for them, etc. But it lowers the risk of new product failure when you see things like that. Then we wanted to see if we could get a breakdown of Britannia's revenue by product line. So unfortunately, Britannia only has one reporting line. So I looked in the annual report, there was no breakdown of product. So we can't get the revenue figures divided into product categories. And the company is very sensitive about giving that out because it gives competitors insight into how each of their product lines are doing and selling. So that's the only real question we weren't able to get any color on. So now let's move to the balance sheet. What were our balance sheet questions? So some interesting findings here. So the first was, what are Britannia's reserves invested in? Are these safe? So I looked through the annual report and I saw the footnotes on all the investment categories. Most of them are pretty routine, run-of-the-mill investments in subsidiaries, joint ventures, mutual funds, etc. But there was one very concerning line that I saw, which is intercorporate deposits. So what are these? These are basically unsecured loans that the company is making to other companies, okay? And it's not so concerning that they're making loans to other companies, but I'm not investing in a bank, right? I'm investing in a food company. So this is a bit unusual to me to see, right? And to the volume that I saw it in Britannia. And the other concerning thing is, if you read in detail, you'll notice that 600 crores of this exposure is to actually related parties. So group companies of the promoter. Now, this is where, I want to do a little bit more work to understand this in greater detail, because essentially what's going on is Britannia is lending money to other companies controlled by the Wadia family. So for example, Go Air is one of the companies that Britannia is lending money to. Now, as an investor in Britannia, right, do I want my money that's being created by this company to be lent to Go Air? I'm not investing in an airline, right? So this is an area that I need to think about a lot more before our next session in 2 weeks to understand this piece a little better. Because one of the things I'm concerned about is we're having an issue where airlines are not going to do well. Is Britannia's cash flow going to go into helping Go Air, or is it going to go into paying me dividends as an investor? Right. So this is a very critical issue to understand. And some of the other intercorporate loans are to companies like Bajaj and HDFC. While they're AAA rated companies, a lot of these companies may face similar difficulties in the current environment. And while I don't expect any issues in repayment of these loans, you also want to understand exactly how to think about these issues. So this is one area that personally I'm going to be thinking a lot about in advance of our next session in 2 weeks. Does Britannia have any property or investments in companies that could be very valuable? So if you read our research paper on Info Edge, you would have seen that hidden value in that example. So I looked through the annual report. There's no indications that Britannia has any kind of hidden value similar to that. Britannia looks like they've added debt in the current year. We need to look at how much. So Britannia took the year-end borrowings to 750 crores. With very little issued previously, right? So this is a big change in the behavior that we've seen with the company. And this again also concerns me because it's a change. Not that the amount that they borrowed was a lot. It's just that, for a company that's never taken debt out before to suddenly take out debt is a little bit interesting, coupled with the fact that they're lending money to group companies also. So I want to think about this also in greater detail. And the reason that the management team cited on taking out this debt is given here. We borrowed about rupees 500 crores in the month of April, primarily to fund the purchases of wheat. But you're always purchasing wheat. So why did you borrow money suddenly to do it this year? So that didn't really give me a good answer. Okay, so now COVID-19. Let's understand COVID-19 and what the company is saying about COVID. So here are some quotes that they said. So then we had COVID hitting us. As a result of that, there was a 7 to 10% downside on our top line and bottom line in March. So it sounds like in March, when the lockdown happened, the sales got impacted by 7 to 10%. We've witnessed a revenue growth of 20% in April 2020 and 28% in May 2020 versus the corresponding months in the previous year. But then in April and May, they had absolutely phenomenal months, selling 20% and 28% more than they did in the prior year, April and May. So why is that, right? Is that because their retailers had drawn down their stocks and then suddenly rebuilt stocks? So that question was asked on the call, and the company said only 2 to 3% of that growth was stock rebuilding. So that is really phenomenal revenue growth. So what happened? How were they able to grow so fast? So obviously we were the first off the block, so we reaped benefits from that. Second, obviously human beings don't stop consuming food. They might switch from one to the other. So street food, eating out was definitely a no-no. Okay, this is interesting. So what the company was talking about was that essentially they were very agile in restarting their operations. So when Kirana stores and all were reordering their products, Britannia was one of the manufacturers that was quickest back to market. So they were able to gain share because other companies were not able to supply. So if a Kirana store, for example, wanted biscuits, maybe in the past he'd get 50% from Parle, 50% from Britannia. Parle wasn't ready to, I'm just using a hypothetical, I don't know specifically about Parle, but let's say Parle wasn't able to sell. Right? Suddenly the guy needs to buy 100% of his biscuits from Britannia, right? So that's, I think, what Britannia is talking about here when they say we were first off the block. And the other trend that they're pointing to is a shift in behavior from eating out to eating at home. So people are eating more packaged foods, and that's also an interesting trend. So the key question is, okay, great, you did great in April and May, but what does this tell us about the next, future years? So management team said, frankly, how long this uptake will go on, nobody knows. So they don't know themselves, but the consumers are now seeking variety. So other manufacturers presumably have now caught up and can service orders from Kirana stores. So my sense is, based on this commentary, we should not expect 20% growth here on out for the next few months, but you'll see lower growth rates, still probably pretty healthy growth rates in June, July, August, etc. Because some of these trends are trends that are going to be around for a while. So street food, I don't know when people are going to revert to eating street food like they were before, or eating out in restaurants, right? Whereas the competition has now caught up to Britannia. Okay, so a lot of questions we covered here. So let's think about structuring these into what we really need to understand going forward as we think about whether this is a good investment. So let's take away key takeaways. So financial performance. So all in all, Britannia seems to be performing pretty well, in my opinion, in the current economic environment. I've looked at a few stocks recently that I posted on our website, and you can see that some of these companies have experienced severe impacts from the economy. So Naukri, Hedge, as an example, has experienced very severe curtailments in revenue. You're not seeing that in Britannia. So Britannia's products do appear to be resilient. Their sales did slow, but it seems like they're outperforming the industry and gaining market share, according to the management team and their categories. The margins did contract due to commodity inflation, which does suggest that maybe that pricing power isn't that good. Maybe they can't just raise up the price of Bourbon biscuits just overnight. Maybe they don't have that much pricing power, and consumers will shift to other biscuits. So that's one thing we got to think about. The company saw a huge boost post-COVID. But this comment here is not relevant. The transcript came out actually today, this morning, so I was able to get the detail. So the company saw a huge boost in COVID. Based on my reading of the transcript, do I think they're going to see that huge boost carry forward? No. I think you're going to see competitors catch up, and I think the sales growth rates are going to come down. But I do think you're going to see resiliency in growth as the company benefits from more people eating at home and shifting their behaviors to eating at home, probably for a couple of months at least from here. So that does portend well to me, at least in the financials. When we look at EPS growth, so EPS growth has been driven by the tax rate. We cannot expect that kind of EPS growth going next year also, because the tax rate won't lower further, right? So as a result, we have to think very carefully in the next session about what kind of earnings per share growth do we really expect next year. Okay, other questions. Company's core products have strong 30% market share, which is growing, which points to a strong consumer demand. The new products are not dilutive to gross margins, but the new products also don't seem to be doing too well. So the good news is, I don't think Britannia is betting the company on the new products. Their margins are acceptable, and if they don't work, they don't work. But I don't feel too concerned as a potential investor that if it doesn't work, the company's in trouble. Now, balance sheet. Here's where we had the most interesting findings. So a couple of red flags that we need to think about carefully in advance of next session. One is the increasing debt levels. Why are the debt levels increasing suddenly? And intercorporate deposits to group companies. So as I think about this, what I'm concerned about is leakage. I don't want Britannia raising more and more debt, and that debt being used to fund intercorporate deposits to other group companies in the promoter group, just because Britannia is doing well. So these are the kind of key takeaways that I had coming from this analysis. So where are we going from here, and how are we going to put this all together? So I just want to recap what we've done, because we've done a lot of work, and that work can seem a bit disjointed, but it actually follows a flow that you can use for any company that you analyze yourself. So we did financial analysis, right? So when we went through the income statements and balance sheets and cash flows, we understood the company financially. We understood the company through its annual report by reading what the company does, what it says about itself. We understood the strategic commentary of the management team. And that led to more questions, right? So as we were doing this, it raised questions. Oh, their sales growth slowed. Oh, their gross margins have come down. Oh, they added debt. Oh, they say they want to expand into new product categories. These questions that we developed from these data points, right? When we answered them, we got an even better understanding of the company. And we're going to use that better understanding of the company and what forces are shaping the company to help us make an investment decision in the next class. And how are we going to make that investment decision? We're going to weigh two things, right? One is the risk and the other is the reward, right? And fundamentally, it's going to factor into what are we paying for the stock and what can we sell the stock for in the future? And is the risk reward ratio appropriate for us, right? And that's really the kind of framework that I want you guys thinking about in advance of the next session 2 weeks out. You've seen all the analysis we've done. Go through it, recap it in your mind, and start thinking about what are the key risks about investing in Britannia and what has to go right for this to be a good investment. And as you start thinking about this and the price you're going to pay for the Britannia shares, it'll help you think about whether this is a good investment or not for you, right? Okay, so with that, I'll open it up for Q&A and then we will conclude the session.
Okay, so the first comment is the brand marketing budgets will indicate the priority and strategy of Britannia.
So yes, absolutely. You can get a lot of sense in terms of what direction a company is going in if you can understand where it's spending its marketing dollars, because the marketing dollars tell an investor these are the places where the company is investing to drive sales growth, right? So if you figure out that, hey, they're spending a lot of money behind croissants and salty snacks, you can figure out that this is a really big priority for them. Or if you figure out that, hey, they're not spending that much on these new products, most of it's going to the core brands, you can figure out that, hey, this is something they're trying, they're experimenting with, but they're not, really chasing this in a very big way. So yeah, unfortunately, it's a bit tough to get that level of granularity. Usually in annual reports, you'll just see a total marketing spend line. You won't see it bifurcated in that way unless some companies give that detail in the annual reports and the investor presentations, which Britannia did not do. So it's a very good thought. And it's something that sometimes we can get lucky and see that level of granularity.
Okay, another comment. The fear is that Britannia is lending to Go Air. You said it right. Okay, so last year, Britannia issued bonus debentures to shareholders, and this has increased the borrowings.
Yeah, so the bonus debenture bit I saw as well. I'm less concerned about that. I'm more concerned about the 500 crores they cited to buy wheat. They buy wheat every year. So why are they debt financing it now? That is something that, to me, in concert with the fact that they could be lending to group companies, what I get concerned about is that suddenly management has shown a willingness to take on debt, right, at the company. There's a group company that's going to need funding because airlines are hurting right now in the form of Go Air, right? So Go Air may need capital. And because the Wadias own both Go Air and Britannia, have ownership stakes in both, their incentives are very different than someone that's just invested in Britannia. If I'm just a common stockholder in Britannia, I don't care about Go Air, right? I mean, I don't want to see my balance sheet going to fund troubles at Go Air, right? So that's really what I'm concerned about in the debt. I'm not super concerned about the level of debt. I'm more concerned about, because it's still very low, I'm more concerned about the willingness to take on debt coupled with the willingness to lend to related parties.
Okay. Market analysts have looked at 600 crore investments in group company. They have said this remains concern, but it has not increased over the last few years. So new cost of 65 crores is due to core business borrowings, teams pressure from outlets on receivables, delay in receiving money. I agree with Britannia commentary of being first off the block as they reached at 40% capacity utilization earlier, while Parley was at 20%. So they got us a head start.
Yeah.
So availability of their products helped them increase their sales.
Yeah. So so on the analyst view on the 600 crores of inter-corporate deposits. So the view is that because it hasn't increased in the past, they're not concerned, or it's a mitigant. To me, and everyone needs to form their own judgments on this, right? For me, this is an area I really want to understand. I want to read everything the company has said on this issue, because what they've done in the past is one data point, but things have dramatically changed going forward because COVID is going to really impact one of their group companies, right? GoAir is going to be dramatically impacted by the lockdown and the inability to fly and fill its planes with passengers, right? They're paying all the fixed costs of an airline. They're only able to cut so much of that, but they have no revenue, or much, much lower revenues than they did in the past. And the question to me is that, is there a risk that Britannia dramatically increases that lending to help a group company out? It may be a rational thing for the Wadia family to do because they own stakes in both. But if I'm invested in just one of them, then I don't want my money from Britannia going out to an entity that may not be able to pay it back. I want that money to go into paying me dividends and making Britannia a stronger business. So while that number hasn't grown historically, I think the future is very different than the past. And we need to understand the ability of Britannia to do that. And there's not a lot of disclosure that I see in the filings that I've read. I'm going to hunt around a bit more to see if I can understand more. The board does review the amount of deposits, but I don't know if there are any limitations per se, and I really want to understand the board composition also. It's not an area I've looked into yet. So those things can help me get comfortable with it or potentially not want to be invested just because of the risk. I mean, I don't know if they'll do it or not, right? But when you're investing, what you really need to worry about is the potential for things to go wrong, in addition to how likely you think it is to go wrong and what the consequences would be if they went wrong. So all those three things need to be factored in. And the setup just seems like there is opportunity for the scenario that I described to happen. It's not saying that I expect that to happen, right?
Okay. Very good fundamental analysis, Sahil. Oh, that's not me. That's a listener typing. I agree so. Borrowings is not a great concern. Even deposits placed with Bajaj and HDFC is not a concern. Concern definitely is lending to group companies. How much is it to go at? That is the key risk.
Yes. Yeah, I would agree. So I would agree that, look, I'm less concerned about lending to Bajaj and HDFC and all these kind of companies. But again, as an investor in a FMCG, I would love that cash to be given back to me in the form of a dividend and let me decide who that money is lent to, right? I may not want to lend to Bajaj or HDFC. I may want to just invest in a packaged food manufacturer. So one of the calls we made in our small case, for example, was to get out of financials because of the risk profile that we saw. And if I see a company that is using cash flows to invest on my behalf, then it begs the question, like, why? Because I should have that cash back in my pocket so I can decide who I want to invest in. So I agree, it's not such a concern for me. But in terms of good corporate governance and all, I like seeing companies either investing in the businesses that they have or returning the money to shareholders in the form of dividends, or making acquisitions that help make a stronger business, So I agree. That piece is not a game changer for me. The intra-corporate deposits could be. I need to study it more. I'm not saying that at this point we still hold Britannia in our small case, by the way. So, but I want to think about this issue deeper.
Okay, great insight. Previous year exposure to GoAir was small. Another comment, which is I do not like boards that allow lending to group companies. And here's a suggestion. Should we look at tail hedge as a strategy in this market condition?
Oh, sorry, what was that? Look at?
Tail hedge.
Tail hedge. Ask the listener what kind of tail hedge he's talking about.
Okay, what kind of tail hedge, Raghav? Oh, buy me options.
So, Sanjay, do you have a view? I'm not familiar with these option strategies, etc. It's not something that I'm super a fan of it personally, but
no, I think, see, in this particular thing, we're not looking at day trading or options on stocks. So that's a different, like more advanced kind of thing. This is more like trying to see buy and hold type of strategies where you may, you're essentially looking at buying and holding for a relatively long time and selling reluctantly if the situation changes. So trading strategies and options and things like that are totally different cup of tea.
Yeah, I think generally options are very good for a investor that wants to turn a certain investment into a different risk profile for themselves. I don't think it's a particularly good way to hedge risks of a particular investment, in the sense that if you identify an investment that's risky, right, the best decision is probably to get out of that investment if you feel like it's too risky for the price you're paying. And I'm not saying that's the case in Britannia. Like I said, we're still holding the stock. But I don't think the right way to address it is to buy an option, because fundamentally you're paying a price for that option, and that price of that option reflects the risk anyway. So a better strategy is using options to say, hey, I am willing to give up a little bit of upside on Britannia to cap my downside, but I like Britannia as a stock, right? So.
Yeah, in that case, you would sell covered calls.
Yes.
Okay. Another comment. I think this is not lending to Bajaj or HDFC in the true sense. The surplus funds would probably be parked in debt mutual funds in these. This may be a legacy relationship and a long-standing deposit.
Yes, absolutely. It could be a legacy relationship. I don't think it's investing in debt mutual funds. I think these are actually buying the securities of Bajaj and HDFC, because they have mutual funds listed separately in the schedule of investments, but possibly. I think this is actually picking up AAA rated bonds, etc., from selected companies like that. And yes, it could be relationship driven. But again, as an investor, I want to see that money come back to me, because I can also buy Bajaj bonds if I wanted, right? I mean, I don't necessarily want you to invest the capital you generate for me.
Okay, I think that is it for today's questions.
Okay. Great, a lot of good questions. And so in advance of next session, you guys should do your own thinking on terms of what do you think the key risks are of Britannia investment? What do you think the upside looks like? What do you think the next few years of earnings look like? And that'll help us sort of frame a decision as to whether it's a good investment or not. And a lot of work's gone into what we've done. And now the key thing is interpreting that work and making decisions for the future.
All right. Thank you, everyone.
All right.